The upside relative to the risk for property investors is when there's downturns or slowdowns, what becomes more valuable is actually what I just explained. And we call that the flight to quality. The flight to quality occurs. All of a sudden, people go, you know what? I don't really want a property in the back of Townsville, but I still want to be a property investor. Geez, what's going on in downtown Brisbane? What's going on in downtown Sydney? What's going on in Newcastle? What's going on in Geelong? Where are the people, and where is the lifestyle? Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, we're going to dig into becoming the resilient investor. Yes. Would you like to invest by virtue of resilience? I think it's important. Economic times are always a-changing. And the best thing about being a wise old fox like myself, I've seen some good real estate markets and I've seen some tougher ones. And I tell you what, I got the lashes on the back from many a bad marketplace. So I've learned over the years to invest in all weather conditions. Today, I want to dig into economics. I want to dig into how to play the game. That is property investment, because property investment is a long-term sport. It's not designed to be a quick hit. It's designed to work through the good times, the tough times, and all times. But you got to do it right. So let's have a good chat about that. Welcome back, regulars. Play the program in double speed. Get your life back. All the episodes I've done are lessons on real estate, so feel free to go back in time. And I've got my little new hat on, the Oracle Red Bull Formula One racing team. Yes, I went to the Formula One the other week. Wow, what an experience. How come I've never done that before? That was daft. I've spent way too long not going to Formula Ones. I think I'm going to travel the world going to Formula One races now. I really loved it. And I tell you what, we had good tickets in pit lane. So, it was unreal. Yeah, I'm a convert, the F1 convert. And I think a few people are, those that watch Drive to Survive. And sometimes in real estate, it really is Drive to Survive. So I want to have a chat about that. Of course, if you're living under a rock, you probably don't know. So I'm going to tell you. The United States and Iran are battling it out at the moment, and that's causing a bit of a shock. Because the thing with black swan events, the thing with economics, it's usually what you can't see that comes and causes the cycle to shift. And really, we can determine how we can invest through some fundamentals. And I want to go over what we can determine and what we can manage in all weather conditions today. But we need to understand that economics is what it is. And there will be periods of property investment where things like the oil price start to skyrocket. So I like to teach some models, and today we'll go through some of those models to understand how to play the game. Just remember though, strong assets perform across cycles. Weak assets perform only in booms. And really, I've seen so many people buy weak assets in the marketplace. It's quite disturbing. And I think, as markets kind of change direction, those weaker assets really don't perform. Strong assets will work through cycles. And so today I want to talk to you about making sure you've got strong assets, because there's so much opportunity ahead in the real estate marketplace. Really, when it comes to what I do, you guys know my models, you've heard a lot of them, but sometimes they're a bit scientific. And so if you really want to understand what I do, I find strong land and building characteristics, lifestyle demand, and local income that is resilient to economics. Because things are always different in economics, and that is just the way it is. Now, let me put it to you like this. The Australian economy is a K-shaped economy. What is a K-shaped economy? I'm glad you asked. If you think of the letter K, there is kind of three, access points to the letter K. You've got a straight line, and then you've got basically a triangle on the other side of the straight line, or half a triangle, or a boomerang. You've got a boomerang on the other side. And really, a K-shaped economy is you have haves and you have have-nots, and the have-nots going down and the haves are going up. The cost of living is okay for haves. It's just not okay for have-nots. So the trick to property investment, and why I tend to invest in strong land and building characteristics plus lifestyle demand plus local income that is resilient, is to fill up your car is the same in Mossman as it is to a suburb like Penrith. In fact, I just pulled some data. You can go to BP Penrith today and you can fill up your car for $2.17, and you can go to BP Mossman and fill up your car for $2.17. It's the same price. And so Penrith's pretty good place these days, but it's certainly no Mossman. And again, like, the cost of living pressure in the K-shaped economy for marketplaces which are sort of have-not marketplaces, even if you're a property investor and you own real estate in those have-not marketplaces, there's no disposable income. There's a high cost of living because the petrol's the same no matter where you are, for rich people or for poor people. And so I like to invest where there is good socioeconomics. And it means sometimes paying a little bit more for real estate to get into the marketplace. So guys, there's an economy out there, and we live in the economy. We don't live in a cave. And so if we're going to live in an economy, we need to realize that the economy has periods of time where it does different things. And it's nothing to be concerned about. It is what it is. And so if you think of a horizontal access point and you have growth on that access point, an economy grows through GDP improvement. It can grow 1%, 3%, 4%. It can also go backwards, 1%, 2%, 3%. If it goes backwards 3%, it's likely the economy is recessive. What that means is you've got low inflation and negative growth. And typically in a recession, you would have low interest rates. If you think of negative growth, which is stable, it may mean literally the economy is kind of growing at 0%. And things are deflating, things are becoming worth less. And deflation is something we lived through for the last, in my viewpoint, 15 years. We've had, super low interest rates, and, the cost of things has been deflating and getting cheaper and cheaper and cheaper until COVID came along. And so, you can buy 300 socks on Temu for $12. The idea of certain goods and services deflating is real. So the economy is a mixture of all sorts of ingredients, and if more of the economy is deflating, then you get low growth and you get low inflation and typically stagnation, which is just really quite stable. So that's two of the six economic puzzles. Then you've got what is known as the Goldilocks economy. And the Goldilocks economy is what everyone wants. You get a growth rate, GDP-wise, of 2%, and you get inflation at 2%. And the Goldilocks economy is like steady growth and stable prices, and everyone's happy. It's kind of like the balance of it all. And of course, most property investors, when they psychologically accept that they should move forward in life, tend to want the Goldilocks economy. They just want everything perfect so they can bravely make a decision to invest. But as we know, the Goldilocks economy, out of a 15-year period, is a small part of the economy itself and the way the economy moves around. So then we have reflation. And reflation, instead of inflation, is effectively that. It is a period of time after inflation where things re-inflate. And reflation is typically where the economy is growing, but rising inflation unfolds because of stimulus and government spending. Really, probably where the economy is at right now, taking away the war in Iran, is reflation. We are reflating. And of course, the Reserve Bank of Australia is kind of all over this, trying to work out, should they press the button and put rates up to stop reinflation? And of course, the government is kind of, realizes, hey, we've probably spent a little bit too much money. So Gymonomics, I call it now, old Jimmy, Treasurer Jim, maybe finally tightening the belt because reflation is caused by government. So there's two other places an economy can be. So there's four. You've got recession, controlled stabilization, the Goldilocks economy, reflation. And of course, there are two others, which is a overheating economy, in the sense that you've got high inflation but strong growth. And in an overheating economy, it's like all growth, all wage growth. It's everything's growing. Everything's growing. Your wages are going up, properties are going up, everything's going up. And, you get this kind of high inflation kind of unfolding. And probably like a true economic period of time where that was pretty robust was like after mining boom one, in 06, 07, interest rates climbed up to sort of 7, 8, 9%, but wages doubled. Properties were on the move, like the economy was just thriving, and you had this kind of overheating effect of like everything's doing so well that it's, if you could not keep up with the robust movement of the economy, you were kind of getting left behind. And inflation will do that. Inflation will leave you behind. Things cost more. I went to dinner last night in a have economy, and it was $500 to go to dinner. That's what it costs. It's like mind-blowing, right? Because inflation, the same meal 5 years ago would have cost $200. Then we've got stagflation. And stagflation is effectively high inflation, high unemployment, and weak or no or growth going backwards. Stagflating. And stagflation is certainly something which is, caused a lot by global occurrences. And it can be pretty short and sharp, or it can linger on. And really, if I was to analyze the economy right now, we're in reflation. Government stimulus has caused inflation, and we are re-inflating. It is what it is. But of course, there is the Iran war, which is happening right now. And as we all know, there is the world is releasing oil reserves to deal with the problem, to keep the idea of too much inflation coming out, because obviously fuel is stuck in the Middle East, as is a large amount of gas. So the world is going through a bit of a shock at the moment. And when shocks unfold, property investors tend to run away. And in my viewpoint, it's the worst thing you can do, because we saw what happened to those people in COVID. There is the people who invested through COVID, and then there's the people who didn't invest through COVID. And there was periods of time in the GFC. There were people who invested in the GFC, and then there were people that paid twice as much for not investing in the GFC. And so all of these kind of ways the economy kind of moves around is just normal. It's just normal. We can have high inflation, recession, the Goldilocks economy. Australia has been very blessed because Australia's business plan is generally more people coming into the economy, and it's underpinned by natural resources. And as such, it's typically always stimulating itself because its primary industry, which is education, brings more people into the country and creates more consumers for local businesses. So we're very, very fortunate here in Australia to have a growing population base as opposed to one which is falling or stagnating. But really what you see in fair weathered economic conditions, such as a Goldilocks economy or a fast moving economy, is investors tend to speculate. They buy in all sorts of weird hotspots you've never heard of, and really become pioneers of investment in strange products and places. And what happens during fair weather is you typically see people buying different typologies of real estate. They will, go into all sorts of strange real estate deals. And what I mean by that, they don't stick to the fundamentals. They leave the fundamentals. They'll buy properties in sub-regional marketplaces which have really few industries in them. They'll run off to cities far and wide to buy real estate, because in the fair weathered world, they swap their money for low grade assets just because the idea of a short term game. And a lot of fair weather investing is also into areas of low socioeconomic cities or suburbs or places. And quite often in low socioeconomics, you've only got one of the family members even working. And so you're in a position where a lot of money flows in, a lot of capital flows into fair weathered areas. And I've always been an investor. Well, I should caveat that. The last 15 years of my investment journey, I've been an all-weather investor. The first 15 years of my investment journey, I would say I was a fair-weathered investor. I would follow the hot spots, and guess what? The hot spots became the not spots, because in bad weather, speculators, which are investors which are not necessarily here in true good fundamental suburbs, wake up and go, holy cow, I own a property in Broken Hill and there's the cost of fuel is now $2.50, but in Broken Hill it's $3 because it's so remote and everyone's broke and I own real estate there. So what happens is speculators in bad weather, and I call them speculators, they're property investors, but just doing it in strange places, sub-optimal marketplace, B-grade marketplaces, they start to panic and they start to leave those marketplaces. And so in bad weather, fringe hotspots do lose value pretty quickly. And so I've seen this firsthand. I got the lashes on the back from it, seeing it firsthand. And, one marketplace I've got the lashes on the back is Gladstone. Like back in 2010, 2009, I was buying in Gladstone because it was a hot spot. There was a lot of people going into that marketplace to capitalize on extra economics around, lots of jobs in that marketplace, infrastructure buildings occurring. And overnight, literally overnight, the marketplace went from boom to bust overnight, literally a change in a couple of the companies that were working up there's basically housing policy meant workers were housed basically in FIFO camps as opposed to the local community, and that changed the fundamentals overnight because actually there were no fundamentals. It was just a buzz. And again, like a lot of buzz causes growth. And what you see a lot of the time in fair weathered is investor agents, buyers agents will recommend one place and it becomes a self-fulfilling prophecy of growth because investors are battling other investors to get real estate in those marketplaces, and it perpetuates growth. But the growth is not sustainable because when bad weather comes along, there is no fundamentals, so the growth actually departs the market, and that leaves people in a vulnerable place. In other words, property goes up 100, but goes down $200,000. And so the bad weather is really connected to low socioeconomic asset selection in fringe marketplaces where there's an oversaturation of investors. So I use all-weather investing. That's my model. That's what I do, and I do it because it's boring and it's safe, and the likelihood of losing is a lot lower than the likelihood of gaining. it sometimes bores people because the rental returns are 4%, 3.5%, 4.5%, 5%. They're not as high as the markets which are more speculative. And so they actually can often feel very, very, very boring. But all-weather investment markets are marketplaces where the population typically wants to live. Your Sydney, your Melbournes, your Brisbanes, your Geelongs, your Newcastles. These are all-weather investment areas. And so when you think about all-weather investing, it's how's it done? Well, it's done for the reason, or why is it done? It's done for the reason that through a 15-year journey, there's guaranteed to be a bump or two along the way. And so typically all-weather investment areas are established locations with strong owner-occupier demand. They've got great tenant demand. They've got great proximity to infrastructure and amenities, higher socioeconomics. They can spend money. They can circulate that money in their own economy. They're lifestyle-orientated areas. The land value is anchored to the cost of production. The markets are full of fundamentals. They can be middle ring. They can be sector urbanization. They can be live, work, play urbanization kind of marketplaces. And there's infrastructure and investment and economic clusters beyond one industry. So what happens is when a marketplace in bad weather has no fundamentals, but it has capital going into it, the capital realizes all of a sudden in bad weather, that's a pretty dumb idea. So what happens is we often think of cycles as almost like just humans deciding to put their money somewhere, which they effectively are. But money is capital. And what happens is you'll see capital flow into a marketplace with no fundamentals because of other people putting their capital into those marketplaces. And really, belief is the reason. Belief of short-term gains. And I would say, 75% of Australia's property market is just belief. It's just more humans believing in something than is actually real. And so what happens is you get this capital flow in. If you think of a triangle and you put at the bottom market with no fundamentals, and then you put on the side of one of the upward facing access points, money flows in, capital flows in, and then realizes there's no fundamentals when there is bad weather. And what does the capital do? It flows back out again. In other words, the real estate market goes up and then it goes down. And we often call that a sawtooth real estate market. Sawtooth. It's up, down, up, down, up, down. When you look at a marketplace which is full of fundamentals, it's the polar opposite. Fundamentals, if you go back to the triangle, if you put fundamentals at the bottom, capital flows in on one of the access points on the side. Does the capital leave? Well, no. It stays. And what does it do? It circulates. It circulates. It opens more businesses. It builds more infrastructure. It passes through more hands. It circulates in the economy. And so capital flow is really the idea of what pushes real estate markets up, capital flow. But many a real estate market goes up based on no fundamentals. You don't need fundamentals for real estate markets to go up. That's the reality of it. And so I'm very dogged, and everyone I work with who's been around for a long time in real estate is very dogged that we would prefer to make no growth but be in a fundamental-based marketplace rather than try and ride the wave of a sawtooth, non-fundamental marketplace. That's how we roll, because we want the retention of capital, And so fundamentals are a key thing. And of course, you guys probably know from a macro level, fundamentals like population growth, infrastructure spend, and economics and jobs is really the idea, the pie economy, employment, infrastructure, and population growth. Well, of course, you're going to get that in areas where there are big cities and feeder sister cities like your Newcastles and your Toowoomba's and your Geelongs and your Gold Coast and your Sunshine Coast. But certainly from a local fundamental perspective, there are ways to make sure that your investment is all weather. It's all weather. It's going to ride out the good times and the tougher times. Things like lifestyle appeal. Now, again, I think lifestyle is the single most important element of property investment today. Why? Because lifestyle is a key and simple methodology of determining have and have not marketplaces. Have not marketplaces, there's very little lifestyle. There's very little action around beaches or parks or coffee shops or shopping precincts. There's very little places people enjoy their local community. So those people leave their local community and go to places that have that on the weekend. That's what they do. They live in those areas and then they go and try and enjoy places of lifestyle appeal on the weekend. But lifestyle appeal places are not cheap. They're not cheap. And a big part of my job is to try and find lifestyle appealing marketplaces, affordable yet highly livable marketplaces. And it's bloody tough. It's bloody tough because it's a lot of people's budgets don't mirror the lifestyle cost to enter those marketplaces. So quite often we'll use urban hierarchy theory, the urban hierarchy theory. Well, if Bondi is the best beach and we can't afford that, let's go to the next beach, or let's go back 2 or 3 suburbs if we can afford that. And I just say Bondi because obviously it's a brand that a lot of people understand. But again, the idea of local fundamentals is lifestyle appeal, access to transport, proximity to employment, the idea that business and people cluster together. So if we've got good local businesses, we got people spending, the shops are open, there's no for lease signs up, then the community is circulating capital. And that's what we're looking for. Established infrastructure or soon to be, planned infrastructure is what we're looking for. We're looking for belts, like green belts, like where are, the nice green leafy suburbs, sand belts, where is the water? Where is that blue effect, that blue ocean effect or river effect? We're looking for belts, school belts. Where are the best schools? Education medical belts. Where are the universities? Where are the hospital precincts? Where are the cultural belts? Where do the yuppies want to live? Where is their culture? Where are the surfies want to live? Where is their culture? We're looking for the belts to give us the fundamentals of the socioeconomics of all-weather investing. We want, accessibility theory, the ease of access to important destinations. We want that, and like I've got, sometimes I default to sort of where I am just to explain this stuff. But like, say, Manly, access to important destinations is a 15-minute ferry ride. The important destination is the CBD. So again, like the fundamentals at a local level are completely different to buying, I don't know, in Townsville or something. It's completely different. And so then all of a sudden you've got, because those marketplaces are really good in good weather, but less fun in bad weather. We want all weather across our investments. And again, like local fundamentals, like location competition theory. The best locations attract the highest bids for the property. That's it. The best locations attract the highest bids for real estate. And again, like if your budget's $2-3 million, you can get some of the best locations with the highest bids on them and you'll do very well. But obviously, a lot of people have a $700,000 budget. So what do you have to do? You have to stick to the fundamentals and find, using urban hierarchy theory, the theory of the neighboring suburb, how to spend $750, $850, $950, $1 million in a marketplace which is going to get the ripple attention from the best land going around, the best location going around. And again, it doesn't change. The fundamentals don't change. These are fundamentals. These are fundamentals, and they protect you in bad weather. The halo effect, the neighborhood effect, demand staying, and the retention of capital. The neighborhood effect is simple, and I've explained it many times. Neighborhood effect is more people want to stay in the neighborhood than leave. I'm doing a deal in Strathmore at the moment in Melbourne. It's a beautiful suburb, really pretty place. The time on market, well, the average hold time of real estate in Strathmore is 17 years. 17 years. People do not want to leave that suburb. They will die in that suburb. They will, on average, typically some suburbs are as low as 7 or 8 years. In Strathmore, it's 17 years. So demand wants to stay, but also equally, because it's quite a picturesque suburb, demand wants to come. And that is known as the halo effect. People want to come into the suburb. Now, again, if you go to many a suburb where you can spend, I don't know, $500,000, $600,000, $700,000, no one wants to live there. You might be able to afford to invest there, but people want to get out of there. Locals want to leave, and no one wants to come into those areas except, guess what? A property investor speculating that the macro world will look after them, and if they just get into the market, they're going to get capital growth. Very short-term thinking, man. Very short-term thinking. All weather is what we're looking for. All weather is what we're looking for. Now, two things can be true at once. That's the reality of it. And when you are analyzing the fragility of economics, you always need to consider secondary economics, which is what happens next. What happens next? And of course, the fragility of buying in a weird place is, the first economics is the market's going up, I can ride a growth wave. Secondary economic effect is when the market slows down, you kind of haven't secured a long-term real estate hold. Remember, you got to hold the real estate. You got to hold the real estate. So two things can be true at once. And, I think over, the next period of time, you will see maybe some suppressed demand in some of these places. And you will also see a level of inflation through reflation, which destroys purchasing power. So if you don't hold real estate, what happens is the cost to get into real estate just becomes more and more and more and more expensive. And, you might, for example, be a renter, and you're like, well, I should get into real estate, but I don't know, for the next 3 months, oil prices are going to be high. Obviously there's going to be a cost of living squeeze. And really, when there's inflation, the best actual asset to beat inflation is real estate. Pricing power assets. And I've explained this so many times. What do I invest in? Pricing power assets. And I've explained it: food, energy, and real estate. It's really where I'm at. And guess what's going up at the moment? Food and energy. And so I'm hedged and invest effectively investing against inflation. That's really my model. And other people have different models, belief models. Crypto, it's a belief model. Regional, sub-regional areas, it's a belief model. Let's go to a sub-regional marketplace where it's cheap, and the belief will be that it will become expensive. That's a belief. There's no real substantial evidence that that's true, but it's a great belief. And if you believe it, you will get burnt. You will get burnt. Inflation destroys purchasing power. A cup of coffee costs $7, then it costs $8, then it costs $9. Unless your wage goes up, you get destroyed. So two things can be true at once. You can actually have weak demand in real estate because of things like wars. You can have weak demand, but you can have inflation. And the idea of not controlling assets with pricing power when there's periods of inflation is pure madness, because the how it kind of works is real estate is a hedge against inflation. How is it a hedge? Well, for a start, typically in inflation, you start to see a suppression in what can be built. And so what you typically own becomes undersupplied, and usually in inflationary periods, and we are in reflation at the moment, rents will go up. So you're getting paid more for an asset in an inflationary environment. When inflation stops and you go back to a Goldilocks economy, you're getting paid in rent that is typically gained through the inflation period. And so real estate is a hedge against inflation because rents typically inflate with inflation. And that is why it is absolutely critical to invest in all weather investments, because this is when you go positive cash flow. Now, I've seen this before, is the hike in inflation is so rewarding for the haves and so devastating for the have-nots. It's literally how you push rents up. So I guess a lot of people ask themselves right now, you get a few people sort of, I've been doing a lot of events lately, and at events, people are, always asking, like, what happens when AI, takes everyone's jobs, or what happens when, the Iran-America conflict, drags on, or what happens when, China, starts to go into population decline. These are all great questions. But I think we have to realize that the upside of real estate is relative to the risk only if you all-weather invest. If you have to adjust for the risk by going to some weird places, you have to get the real estate in those weird places at a very good price. You cannot pay overs for that real estate. So where is the upside relative to the risk in Australia? Well, let's talk about Australia. What is Australia? Australia is made up of some key industries. Food. We are the food bowl of the world. We are the world's quarry. We have more lithium, gold, copper, you name it, we've got it in the ground here in Australia. Iron ore, we are the world's universities. They come here, people come here in droves to want to live here. We're an attraction country. People want to live in the attraction country. And so we are, without question, a model of the world when it comes to population growth. People want to live in Australia. Now, when it comes to the idea of economics, Australia is also a tourism destination. People travel here. They like to come to Australia. But if we focused on, for example, Australia's economic output, we're an exporter. We export stuff. And as long as exports are humming along, the market keeps humming along. And right now, for example, it'd be nice to get some more revenue from it, but because Qatar is bottlenecked with LNG, all of a sudden, Australia's LNG is really, really valuable because Australia is the second biggest exporter of LNG in the world. We just don't keep enough revenue here from taxes. So we need to solve that. But there'll be periods of time into the future where things change. And the point of today's conversation is just make sure you're invested for change. Make sure you're invested. Make sure you AI-proof your investments. And, people go, well, how do you go and do that? Well, you just stick to lifestyle-orientated areas, fundamentals that are available in the marketplace. You can use my model, which is really simple. Strong land and building characteristics in lifestyle demand neighborhoods with local resilient incomes. It's as simple as that. Now, of course, the best way to actually beat AI is to actually be the person in your workplace who uses AI. So many people in my workplace are so talented that you can see the people who are embracing technology, and obviously some roles are, there is no technology usage to it, but embracing AI, being the person in the workplace that uses AI, will mean you're the most productive person into the future. What will happen if we don't need as many people in the workplace? When that unfolds, I don't know. When I was growing up, a milkman brought milk to my house. And I remember that milk. It was delicious. It was very creamy. It used to have beautiful cream at the top of the milk bottle. And when I think of AI, I think of the milkman. Yes, the milkman became no longer. He became redundant. But did the milkman go and get another job? Yes, he did. If in the office world, AI takes someone's role, why couldn't someone become a milkman? Because all of a sudden, I actually think that a lot of people would pay to have milk delivered fresh every morning. I actually think the milkman could make a return. And the point of the little yarn is things are always a changing. Things are never going to stay the same economically. And just maybe if AI takes an office worker's job, that office worker may become a milkman. And there's nothing wrong with that. And I think a milkman is needed. So you will get the return of different things in the economy is the point of the conversation. The world will not end. But if you own real estate in a non-fundamental marketplace where capital goes in and capital comes out, you will get burnt. You will get burnt. So you might think my economics or the way I invest is boring, but I tell you what, it's working, and it works in good times and bad. That's the reality of it. What other fragilities are there? Okay, we're exporters. We love iron ore. We got more iron ore than you can imagine. We could all have a tip truck of iron ore, put iron ore in our backyard just to look at it here in Australia. It costs us nothing. We've got that much of it. Other countries don't have iron ore. And of course, that is why we export. And of course, we've got big trading partners, people like China. China is 30% of our trading. What if China goes to war with America? Are they going to buy our iron ore? Probably not, because we would have a security arrangement with China. Would that be a bad period of economics? Of course, it would be horrible. But guess what? If you're all weathered, invested, if you've got real estate in fundamental places, you will ride it out and you'll end up better off. Every 15 years, there is economic changes over a cycled period of time. You just want to position your real estate investments for good and bad, not just good. Not just good. Remember, when I started the conversation today, I said it, strong assets perform across cycles, weak assets perform only during property booms. That's the reality of it. We live in a K-shaped economy. We want local fundamentals. We want macro fundamentals. We know two things can be true at once. Inflation destroys purchasing power. And when there's tension in the world, there is suppressed demand. And so things still go up, but if you sit out of those kind of situations, you kind of tend to miss out. So one of the things I think is really, really good when you go into bad weather, and we don't know how long the Iran conflict could be. Donald Trump is a pretty crazy cat at times. You know, he's impulsive, and so he's very hard to read as a leader. The market struggles with him because he could wake up tomorrow morning and go, rightio, that's it. We flexed our muscle. We've done a deal, the art of the deal. And it wouldn't surprise me if in 3 weeks, you know, we're sort of all talking about something else. But really, the upside relative to the risk for property investors is when there's downturns or slowdowns, what becomes more valuable is actually what I just explained. And we call that the flight to quality. The flight to quality occurs. All of a sudden, people go, you know what? I don't really want a property in the back of Townsville, but I still want to be a property investor. Geez, what's going on in downtown Brisbane? What's going on in downtown Sydney? What's going on in Newcastle? What's going on in Geelong? Where are the people, and where is the lifestyle? I will flow my capital to quality, and it's a really beautiful thing, because in the market sort of weaker periods, the better assets do generally quite well. And really, if you are listening right now and you're going, well, geez, I want to invest. I'm a bit scared. The world could end. We could stop exporting iron ore to China. We could, run out of fuel and we'll all be eating baked beans. Where should I invest? Well, of course, you could just ask yourself a key question. Where is the most of the downside already priced into real estate? Where is the downside priced into real estate? And where you find a marketplace which is already downtrodden, it's already priced. It's already gone down in value. And it's pretty simple where that has been. That has been in Melbourne. Melbourne has gone down in value for the last 5 years, so it's pretty downtrodden. So it's already priced in. Weakness is already priced into the market. And if you want to follow a cycle which is at the bottom and you don't want the risk of paying too much and the market sort of correcting, then you just still invest, but you go to the fundamentals of one of the Victorian good cities from Geelong, Ballarat to Melbourne, which are all in that 2-hour radius, which is what we look for when it comes to where to invest, particularly off the back of work from home. So prices have already reset to levels consistent with the start of a new cycle at the bottom. And so you can adjust for any risk by going to that marketplace. It's a pretty simple kind of equation. But remember, when it comes to investment, we're looking for what we can determine because we cannot control uncontrollable forces. There's structural fragility in Australia's export economy. If the importer doesn't want the exports, that's structural fragility. And of course, Australia has had a great growth run off the back of China. China basically urbanizing was a wonderful thing for Australia. There are other places around the world that are still yet to urbanize. The African continent needs a lot of infrastructure. And in some ways, into the future, Africa is going to be, as spoken of as the next kind of global marketplace where there's going to be a lot of growth when it comes to new buildings, new roads, the need for iron ore. So structural fragility is a counterparty risk, and Australia is part of the world. And there's counterparty risk when you do business with the world. That's the reality of it. So we can only determine what we can invest in. We can't really worry about the world, or we'll always find an excuse to worry about the world, because every week on the news, there's something to worry about. Whether it's the war, whether it's Ukraine, whether it's, some politician saying something stupid, it will basically give you analysis paralysis if you focus on the uncontrollable forces. I can't control them. You can't control them. No one can control them. What can we control? That we do not become a fair weathered investor. We can control that we don't do that. We become an all-weather investor, And so there are determinal investment forces that we can use. And it's very, very important that we follow where wealth is flowing, where capital is flowing, where money is moving to, and it's going to happen with or without the economy going well or not so well. It's going to happen not because government is stimulating something. It's going to happen on its own accord. It's going to happen not because there's a grant in place that is fueling demand. It's going to happen on its own accord. And so we can determine what those forces are. We can read them. And that's how we invest. And that's how we follow all-weather investment. Where is the capital moving to? Where are the people moving to? Where is the capital circulating? Where is intelligence unfolding? Where is value unfolding? And really, that is capital flow. We can find it. We can find generational flow, where millennials are moving to, where inheritance is being transferred, where baby boomers are all cash on investments, securing properties in a marketplace for no debt marketplaces, not full of investors. We can determine that. It's easy to find. And again, this is the point of today's conversation. You invest in what you can determine. You don't invest in what is belief. Belief is just fool's gold, greater fool theory. Belief is another fool will come along and pay more for it because growth has unfolded. And you just need to be very, very mindful that growth can unfold in fundamental-based marketplaces, which is great, and it can unfold in speculative marketplaces, which is not so great. You can determine where you enter the market. You can buy at the bottom of the market right now in Victoria. You can determine that. That's your determine. You may not get an instant growth straight away, but so what? If you're not in, if you don't need, to feel like you're getting ahead overnight, you can still get a property on sale right now because literally that marketplace is recessive. And again, if I go back to, and when I say recessive, I mean like it's already gone through its low. It's already gone through its downturn. And in some ways, if you go back to what I was referring to before, which is, the economy can be broken into 6 kind of patterns: recession, stabilization, the Goldilocks economy, reflation, an overheating economy, and stagflation. Well, you could say that the Melbourne marketplace as a property marketplace has left recession and gone to stabilization, but it's still on sale. It's still bloody cheap. And then you could say, I don't know, a place like Geelong right now is actually a Goldilocks economy, steady growth, stable prices. You can get well-located land and steady growth for a stable price. It's a Goldilocks marketplace, which is great, which is unfolding because of capital flow. And so it's interesting. You can actually use the economical framework to layer it over real estate, And it's going to be really, really interested. I'm going to be very interested as to if the war drags on, just watching some of these sort of B-grade marketplaces lose their capital. And I wouldn't want to be owning real estate there. I don't recommend it, and never have. Well, actually, I shouldn't say that. I did in the first 15 years of my economic life in real estate, but I never have since really the GFC, which is pretty cool. I kind of steer clear of all that kind of stuff. I got the lashes on the back from speculative real estate investment. So guys, geographical economics is what it's all about. Location. All right. So geographical economics is fascinating. When you think about it, right now you are seeing at a global level geographical economics. You got Iran that controls the Strait of Hormuz, which is geographical. Economically, that causes counterparty risk because they control that strait. America is the most powerful country in the world, and geographically, it's positioned to be the most powerful country in the world. Why? Because of its geography. It's got the Mississippi River flowing down the middle of it, which creates very arable land. It's got two major oceans either side of it, which gives it such trading power. It's got deep water ports on the Pacific Ocean and the Atlantic Ocean, which just gives it incredible access to trade and commerce. It's got the Panama Canal below it, which allows it to maneuver around trade. It's got a cheap labor source through the South Americas and Central Americas, which it can utilize. It's protected above it with a land buffer through Canada that is a friendly nation that it doesn't have to gear up and, worry about. So geographically, it is very, very wealthy. Geographically, it is very, very powerful. Now, my wife comes from the polar opposite, the poorest country in Europe. Why is it the poorest country in Europe? Geographically, it is a basket case. Geographical economics constrain wealth in that country, the country of Moldova. Moldova is a landlocked country. It has a little bit of water that it basically shares with the Ukraine. It has no wealthy neighbors. It doesn't get the urban neighborhood theory of the ripple effect of wealth from its neighbors. It's basically landlocked. It has no trading routes. And again, it just is geographically a busted ass place, full of Gopniks wearing red Adidas tracksuit pants. That's what you get in Moldova. And of course, the reason I highlight that is geography is economics. We are seeing it firsthand. Now, it'd be great if you distilled that down to real estate investment. Where is the Moldova of real estate investment in Australia? Because you don't want your real estate there. Where is the America of real estate investment, which is a land of plenty, a plentiful place? That's where you want your real estate. You want your real estate there. And again, I'm a big fan of my Forex growth plan, which just really hones in on locations. Marketplaces which are monopoly-based marketplaces, the Strait of Hormuz of Australian real estate, the monopoly. You have to pay us to come past, and really, all fun and games, but geez, you just don't want a Moldova. You don't want a Moldova. If you got the Moldova, on the monopoly board, it's not a good card to pick up, right? Geographical economics is real estate economics. It happens at a country level. It happens at a local level. And so all-weather investing is geographical economics. That's all it is. We want where people want to live. We want the best economics around that, and we want the best lifestyle. All right, folks, that's it from me. We'll talk again. In fact, I might come back next week and do another episode on asset selection. I was thinking about it as I was talking for all-weather investing. Would you guys like that? Probably, you probably may, or you may not. Thanks, folks. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.